Every portfolio faces one strict mechanical barrier: crossing the threshold to actual wealth generation. You must outpace the erosive pressure of inflation. When seeking to protect capital from that erosion, the default allocation for risk-averse investors is traditional safe haven assets, specifically debt and real estate. This chart tracks long-term historical performance. Over a 20-year horizon, real estate delivered a 7.7% compounded annual growth rate. Debt tracks identically alongside it, yielding a 7.6% return. Plotted against historical inflation, the margin of actual real return is dangerously thin. Allocating heavily to debt and real estate keeps your capital in a state of wealth preservation. It defends the money you have, but it lacks the velocity required to multiply it. To break away from that baseline, a portfolio requires an engine capable of generating excess yield. Historically, that engine has been equities. Broad equity markets have reliably outperformed inflation by a margin of 7 to 9% over the long run. The primary friction point for both wealth managers and retail investors is the perception of risk. Capturing that excess return means exposing capital to the daily volatility of the stock market. True multiplier effects are not achieved by accepting blind risk. They are engineered by neutralizing market volatility through strict time horizon extension. By deconstructing the June 2025 asset class matrices from Funds India, we can map the exact mathematical relationship between time allocation and wealth multiplication. To see how this operates in practice, we have to isolate the 20-year compounded multipliers of the major asset classes. This matrix details exact long-term yields. Looking at the 20-year column for Indian equities tracking the Nifty 50, we see a baseline compounded annual growth rate of 14.6%. Over 2 decades, that translates to initial capital multiplying 15.2 times. The U.S. equity market generated a 14.3 times multiplier. Gold also shows historical strength over this 20-year window, delivering a 15.5 times return. Compare those directly against preservation assets. Debt and real estate reached just 4.3 and 4.4 times initial capital. This chart visualizes that math in motion. One unit of capital splits into distinct trajectories. The preservation assets cluster near the bottom, while Nifty, the S&P, and gold follow aggressive upward curves. Securing a 14 to 15 times multiplier is the baseline for long-term growth. From here, we restructure internal allocations to seek even higher returns. That 15.2 times multiplier represents the broad, large-cap baseline, but the equity market contains specific segments that have historically yielded higher premiums. This index table breaks down historical performance by market capitalization, identifying where excess alpha has resided. Moving down the capitalization curve, the Nifty Mid-Cap 150 Index delivered a higher compounded annual growth rate of 17.5%. Pushed through the compounding equation over 20 years, that extra 3% expanded the total wealth multiplier from 15 to 25.3. The Small Cap 250 Index followed a similar path, generating a 19.2 times multiple on invested capital. By tracking these trajectories, we see the broad index acting as a floor. The small and mid-cap allocations pull away from the large-cap baseline, lifting the total portfolio yield. Shifting exposure down the market capitalization curve is a structural mechanism that historically adds between 4 and 10 multiples to a total 20-year return. While index tracking sets the baseline, certain actively managed funds have historically pushed these returns toward the absolute ceiling of the 20-year multiplier. This table examines specific funds that manage to capture outsized market cap premiums. The HDFC FlexiCap Fund reached a 27.2 times multiplier. In the mid-cap space, the Nippon India Growth Fund captured a massive 30.5 times multiple. These examples show the highest historical multipliers were achieved through a combination of aggressive market cap allocation and focused high-conviction management. Posing the logical problem, if mid and small caps offer 25 to 30 times multipliers, the question is why any capital is allocated elsewhere. The barrier is the volatility these equities exhibit over short-term holding periods. This heat map charts the rolling returns for the Nifty 50 since its inception, allowing us to quantify the exact historical probabilities of capital loss. If you deploy capital with only a 1-year holding period, you face a 23% historical probability of negative returns. But the core mechanical truth of equity investing is that time mathematically dampens volatility. Extend your timeline to 3 years, and that probability of loss drops to 6%. At 5 years, it reaches 0.1%. At the 7-year mark, historical instances of negative returns flatline. The absolute lowest recorded return is a positive 5%. Looking at the upside probability over that same 7-year timeframe, history shows an 84% chance of generating returns greater than 10%. Equity risk is a function of time. Commit capital for 7 continuous years, and the risk of nominal loss is historically neutralized. We can plot these two datasets, the wealth multipliers and the 7-year risk decay, onto a single framework. Tracking the risk curve first, the probability of securing greater than 10% returns spikes quickly, locking into a flat plateau at year 7. Simultaneously, the actual wealth multiplier begins an exponential curve, accelerating rapidly as it passes the 10 and 20-year marks. Year 7 is the intersection zone. This is the point where historical portfolio safety aligns with the trajectory of exponential growth. Optimal portfolio construction relies on this intersection. While short-term pricing is volatile, a 7-year holding period provides the mathematical baseline needed to reliably outpace inflation. The historical milestones derived from these matrices dictate a clear strategy. Investors have seen an 80% probability of doubling their capital within a 6 to 7-year window. That same 80% probability has applied to tripling that capital in 10 to 11 years. Attempting to reach those milestones using debt or real estate exposes the capital to steady erosion from inflation. Your portfolio must be segmented by strict time horizons. Aligning capital with a minimum 7-year hold is the prerequisite for shifting a portfolio out of simple wealth preservation and into structural, multi-decade wealth multiplication.